Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about recession signals and what they mean for housing. Logan, welcome back to the podcast, fresh off of CNBC this morning.
Yes, just got done a few minutes ago, and now I'm here. So always on the run.
Always on the run. Okay, well, what do you want to talk about today?
Well, it's interesting. What CNBC wanted me to answer is kind of like, the Fed's always talking about, well, rents are lagging, but we do believe that it needs to eventually catch up to the reality of current rents. But the anchor actually asked me an interesting question. Do we need a job loss recession for affordability to get better? And kind of in this context, what we talk about when we write our labor articles, we talk about the labor data in totality, and that wage growth really matters for rent inflation. So as wage growth is slowing down, right, and we get more supply coming up, then that equilibrium over time should get better. Now, a lot of the disinflation is happening in apartments. Single-family rents are holding up well, and you have a lot of dual household incomes with single-family rents. So that's a different ballgame than apartments. But they kind of wanted to think, do you get major deflation in a job loss recession? And, one of the things I've tried to stress is that, majority of the time in recessions, home prices actually go up, especially in the last few cycles. In the early 90s, like nationally during the recession period, it was down maybe 1-2%. Of course, 2008 was something completely different. That was a credit boom and a credit bust. But even in the early 80s, with higher interest rates, home prices rose. But so I was trying to think, like, how do we get people to understand the supply and demand equilibrium of a recession? And the anchor made me think about what happened during the tech recession, for housing. So we don't have 2008 credit models, so that's almost useless to use, right? People use it all the time, but I would argue they're not actually housing people. But the tech recession, housing starts, permits weakening a little bit going into there, but no real big drop off on that area. Home sales were kind of flat going in, and then they actually rose during the recession. So again, disproportionately hit. If the economy is good and inflation is rising, rates go up, that disproportionately impacts housing, as we've seen in the last 2.5 years. But what if mortgage rates get down to 6%? What if mortgage rates get down to 5%? We're not talking about 3 or 4 or anything. What about there? Where sales are so low, you get a boost in demand. We've seen that in 2022 and 2023. When rates fall, we get this, a big 1 or 2 month spike in sales. And then when rates go back higher, they come back down. What happens if mortgage rates trend to 5 to 6 and just stay there? We're no longer going back to 7 and 8 because we have a recession, right? People are losing their jobs, and the Fed can't sit there and keep on saying the labor market's tight, the labor market's tight. Housing, in a sense, disproportionately gets benefited in that because demand will pick up. Now, a lot of people always go, well, all these people are unemployed, are going to run, 10, 15, 20 million people are going to lose their homes. We have to realize the foreclosure process in America takes a long time. So if you're counting on that, that's like a 2025, 2026 story, because 30, 60, 90, 120-day lates are near all-time lows. Once you get the notice of default, all that, it's going to take time to get that in the marketplace. So before that market, even supply hits the market, you're going to deal with real-time housing equilibrium economics, right? So the bond market's not going to sit there and go, let's hold up on the bond market going down until 18 months when foreclosure supply. No, we go right into the Monday morning, and where is it going? So right now we've seen this because the last 2 years have shown us this. And part of my concern, one of the things I talked about at CMC, I would feel much better about the housing market when we get 2019 inventory levels, because hypothetically, if rates come back down, demand picks up. If you don't have that burst of supply, then guess what happens? Inventory goes down. That's what we've seen in the last almost 14 years with how housing data works. So in this context, I think going back to the tech recession gives you maybe a better perspective of what could possibly happen rather than the 2008 economics theories of, God, if by now, hopefully by now, after all I've done for the last 12, 13 years, especially the last 2 or 3 years, we don't have that backdrop anymore, right? It's 2024. In fact, next week when the existing home sales comes out, it's going to show kind of strong year-over-year price growth. But just remember, the year-over-year comps are really easy right now. So I would argue home prices aren't like that strong, and our weekly inventory data is picking up on inventory. So let's kind of bring that topic to like what happened during the tech recession with housing. And it makes kind of sense. Inventory actually fell, demand picked up. There was no surge of foreclosures. Renter financial profiles got hit harder. That I think is a better place to start off with than going 2008 garbage all the time.
So, okay, but define tech recession. Are you talking about the .com boom? Or are you talking about like
yes, the .com bust? And in that context, I think 2.5 million people lost their jobs. The unemployment rate did go up, but it wasn't like a big, retail sales, I don't even think went negative year over year during that recession because a smaller pool of workers lost their jobs. And existing home sales were actually much higher. They were around 5 million and they started to pick up. So I think a counter to my premise would be that, well, okay, rates will come down and demand will pick up, but the supply will override the demand, and you could get more stress in there. And to that, I would say, let's wait and see how the weekly data goes. Let's not do a hypothetical theory. That's why tracking weekly data is really key, because back in November 9th, when things started to get better and changing, it took everyone 6 to 7 months. At this point in history, you don't want to be lagging that bad again. So we track the weeklies for this purpose because we want to see how the market reacts to higher rates or lower rates. And rates have come down a little bit in the last a few days, and we'll see how that works out. But I think that the tech recession or the .com bust is a little bit better backdrop than to say, we got 4 million active inventories in 2007 with 4 years of massive credit stress building up. Then the job loss recession happened and we didn't have a very good response. We're not there. We're not going back to that time period anymore. So I think a little bit dose of reality when people talk about it, as the anchor asked me, do we need like a major job loss recession to make housing kind of affordable?
It's a great question because, that's what we're all trying to figure out is like, how does this continue at these levels of unaffordability for some people? Obviously, as you've said, there's a core group of about 4 million people who can buy homes every year despite what's going on, in affordability or the economy. We just have that layer. But for the next level, it's pretty tough out there.
It is, but also one thing, millennials are back to number one. Right. They're and to be honest, some of the millennials are so old that they're buying their second home. Right. They kind of bought in their mid to late 20s and now they have kids and now they could do the move up. When we talk about this side of the housing economics, what we know is true is that we have a very big patch of people ages 30 to 39, like this decade. In 2007, the population growth of prime age workers peaked in 2007 and then declined. I've talked about this with you for so many years. Nobody else talks about it. Like I thought that was a really big deal. That was the whole, we're going to have the weakest housing recovery ever premise in the last decade. So we have these people ready to go. Housing demand it's really rare to really crash below 4 million. So we had the greatest test ever in history, right? 47% home price growth, mortgage rates getting to 7 to 8%. And that level still held. But if you think about it in the context of over 158 million people working, right? And then you have the upper income cash buyers, it shouldn't be that crazy of a thought because 4 million isn't that much compared to the workforce. It's not like the car market where you need like 15 million homes or car sales a year. So I think the whole savagely unhealthy housing market really started with this economy going into 2020. Like people forget about this. Like I always know, like people, if they track housing, not a lot of people remember this. Housing broke out before COVID hit us. like the first few months of 2020 broke to pre-cycle highs in demand, except inventory had been slowly moving lower. We were on the cusp of breaking to all-time lows. That was like the worst case. That's not the time to have like all of a sudden housing break out. So we have a little bit more home sales. Inventory broke to all-time lows. Home prices escalated out of control. We finally paid the piper for not having enough product. And it's hard to, get that back down to 2020. I'm like, all housing bubble boys are, prices have to get back to the start of the bubble. That means you need a 47% nominal home price crash. All of you out there, homies, listen, if you're doing this, right? Remember the housing bubble boys 2.0, 2012 to 2019, all said home prices have to come back to 2012 levels. They were so off that they got absolutely eviscerated. Why? Because they're not housing people. Here, you got to get home prices back to 2020 levels. Okay, that's going to be a stretch. So the affordability issues will be here. And the only way to alleviate that is wages have to grow. If prices decline and rates fall, something like that can maybe get the equilibrium better. But again, that 4 million home sale level is there. We're going to have existing home sales come out. It's going to be probably a little bit above that. And we've run through the gambit of, unbelievable, terrible home price growth and higher mortgage rates accelerating. And we're still kind of here. So I think it's going to be so interesting when the labor market breaks. We have to go straight into a change of all economic discussion. This is why I say that 323,000 4-week moving average of jobless claims. I'm ready to go into that area, but I can't go there yet. I don't want to be like a lot of people. Recession, 21, 22, 2020, and then just double, triple down and just like prove that I'm not that good at, tracking data. So once we get to that level, we're going to change all the discussions, right? And there's different things to track and different things to work off, but we will be there 24/7. We're not going to leave you. We're not going to be one of these people that do a forecast and then you don't hear from them for 6 months, right? We don't do that. Every single day, 24/7 live. We're there. We're there to back you up.
So let's talk about what that recession might look like. So you've had 6 recession red flags raised for what, 18 months, something like that, and then one of them came down.
All six flags were raised on August of 2022, but the 5th flag came back down after November 9th. Why? Because rates started to fall. The builders started to sell homes. They're working off of builders. So the builders' confidence went up. In fact, that was actually one of the discussions on CNBC about, what are we doing with the builders now? Well, this is interesting because I think people forgot we had multifamily permits expand while single family permits had a waterfall, an absolute waterfall crash. Now, historically, that's very recessionary, right? Housing leads to recession. But we're working from such low levels of new home sales. The builders' profit margins were good. They can move the needle. That was the whole, we needed higher rates to put home builders on their ass, and it happened, and they started cutting deals, and they moved sales up, right? So that flag was raised down. And in the article we wrote last week for the housing starts, you can kind of see that every recession, residential construction workers lose their jobs, right? But this time, right, we're still growing. Well, we have a backlog. So I think a good thing, one of the things I told CNBC is that it takes 21 months to finish an apartment project, right? So it's not like these things are done in 3 months. Oh, we have no more permits. You guys are gone. The backlog has kept people employed, not only just for apartments, but for single family. And they're kind of working through. So we already have hit the, permits are at COVID-19 recession lows. If it keeps on continuing, we're going to get to the Great Recession lows. That's going to be a problem 2 years down the line, because all of a sudden it's like, okay, we have to start all over again. You see 21 months. See, there's the problem. If you lose the consistency of building, you're going to have periods in time where not much is happening, right? So thankfully we have a backlog and we're hopefully get everything as done as possible. I don't think all those projects are going to get finished. You run the numbers, it's not going to make sense. So housing inflation in terms of rents, it's really rare to get major rent deflation, right? But we could get the growth rate of wages coming down, the rents slow down, and then the Fed will be happy. But we're kind of already, the permits are already at recession lows already for apartments. So that'll be, we'll pay that piper down the line. Single family is starting to soften up back-to-back months. So if rates come down, the builders can work with that a little bit. But the apartment boom is now, as we can see, at recessionary levels today.
Okay, that is a great explanation too, because we know that when construction workers lose their jobs, that has a huge effect because they're so, that's a pretty giant industry, right? Housing. That is going to spur what you talked about with the 323,000, and that can directly affect rates.
So when we talk about economic cycles, for those that read the article, I like to show these long, multi-decade economic expansion charts with housing data. So single-family permits fall, multifamily permits fall together, and oh boy, then the recession isn't that far off, right? So why rates go up? Housing gets hit first. Construction workers lose their jobs. Jobless claims start to rise, right? So that's that, first wave of jobless claims getting up there. What hasn't happened? We haven't lost the construction workers. And those charts and those articles, you don't have to read. You just visually see. Like the residential construction workers haven't lost their jobs. So the inverted yield curve and everything else, it was missing that component. This is why I'm like laser focused on that and trying to teach like stock traders like what to follow. Completions of apartments actually matter now because there's a ticking time game right now. The more you complete, and without permits growing, the less construction workers you need. So we're in that time frame now. We're going to watch that. But now that you have single family permits falling and multifamily permits, that is something new, right? Because in 2022, I think a lot of people forgot this because everyone has a life and nobody's a loser like me. Single family permits were collapsing, but multifamily permits weren't, right? So this would be one of those things where we have them both coming down together. We need to keep our eye on that out there. And then, again, when you stay restrictive policy long enough, eventually you impact future production. And that's the business investment that when Jerome Powell talks about, we see stress in business investment. This is what they're talking about, future production.
It's so weird because, housing leads in and out of a recession and is disproportionately hit at different points. So housing has been in a recession since 2022.
Existing home sales, yes. The new home sales sector, no, because they're growing. So that's the one. So I would say 1/3 of the housing market is still growing, but the 2/3 isn't. So when we talk about, it goes back to that CNBC interview in 2022. Where we talk about the housing market is a recession. When I think of existing home sales, why I haven't taken existing home sales off, there's a lot of people that say that marketplace is not in a recession until home prices fall. No, that's not how it works. The existing home sales market is a transfer of commissions, right? Between real estate agents, loan officers, escrow title. So wages and incomes just collapsed, right? And it's still trending at low levels. Could you imagine if the entire country's wages and jobs collapse as much as housing did? Oh God, unemployment rates would easily be above 10%. So in that context, you're still in a recession in the existing home sales until you actually get credit growth, right? Growing sales year after year, you can get that. To me, if you start to get to 4.72 million on some monthly prints, you're out of the recession. We're growing it. We're not there yet. We haven't been able to keep rates low enough, long enough for that to continue. The multifamilies, that's in a recession. Permits are down. They're just in the backlog. So they're just finishing those projects, 21 months. New home sales are still growing right now. As mortgage rates come, the bigger builders can deal with that. So the builders confidence index, everyone remember, that is more tilted to smaller builders, right? So the home builder stocks are doing great, wonderful. They're outperforming. Why? Because the big builders, we always say, efficient sellers, right? They know what they're doing. Why, Sarah?
Because they're not the March of Dimes.
They are not the March of Dimes. They are not a charity. So, and this goes back to the last decade where I totally disagree with everyone. I don't believe the builders underbuilt. They only build off of their demand curve. We actually had a really good discussion about this with a well-known stock trader. He kind of wanted my take on the builders, and he's been very long, the home builders. I said, okay, advantage, disadvantage, right? What happened in the previous decade? Well, we had 4 million active listings in 2007. Active inventory was higher. But when rates fell, everyone was working with the same page. Everyone for a decade had 3.25% to 5% rates to work off of. So the builders had this major competition from cheaper, older homes that geographically were everywhere. So they couldn't really grow sales. And whenever rates rise, they get their sales hit. They missed estimates 2013, 14, 15. and had a supply spike in 2018. So it was going to be a very, very slow recovery working from a very low level. But here comes 2020. What happened? The exact opposite. Inventory broke to all-time lows. Everyone had low mortgage rates, so that was working well. But then mortgage rates spiked up. So the new home sales sector got it, existing home sales. But at this point, the builder's like, hey, hello, everyone. I got this beautiful brand new house. That home was built in the 1970s. Look at that carpet. Oh, man, you don't want any of that action. Come here, and guess what? We'll give you 4.5%, 5.5% mortgage rates. And they don't need a lot of home sales, right, to move the product, right? They're, 600,000-700,000, where the existing home sales market is over 4 million.
Well, and so the builders in my area, at least 2 builders that I know of, not only buy down your rates, but if interest rates come down in the next 18 months, you can refi the loan for free.
Yeah, that's a whole syndicate. They got all that working.
So,
Definitely, sure.
It's hard to compete against that if you're a seller of an existing.
It is. And that's why I think, the builder stocks have done well. People use these, new home prices are crashing. The builder stocks are just running right over it, right? You can really see the amateurs out there in this marketplace by the things they say. Now, again, total active inventory for the builders, new homes completed for sale that are occupied, 89,000. That's where we are. This is not the sector that brings you millions and millions of homes, right? It never was. That's just not how they operate. So the builders are taking advantage while they can. So if mortgage rates were lower and we had more active inventory, the variable changes, right? Their advantage becomes a disadvantage.
So let's talk timelines a little bit here, right? Because you're talking about as those completions come through with the apartments, and then we have, a job loss among those people, maybe that's going to then affect rates. Like what timeline, like by the end of 2024? Because we've talked about when do we think the Fed's going to cut rates. This is a whole different thing. What kind of timeline, if you're out there and you're a loan officer, if you're in real estate, what are you looking at?
So again, I would always just focus on the deceleration of the tight labor market. And by the second half of this year, wage growth is going to start to get down to that 3.5%, 3%. That's kind of like the level to where I try to get people to focus on, because why the Fed likes this 3% wage growth, 1% productivity, right? So nominal wage growth is just too strong for them, but we finally broke under 4. Why? Job openings are coming down, quits ratios are falling, the labor market's less tight, it's softening up. Softening is different than breaking, but the 10-year yield is still in an uptrend from the lows of 2024. But I think, if you start to see more deterioration in the labor market, bond yields will get ahead of that. So you don't necessarily have to wait for the Fed to, like one meeting, maybe things aren't as good anymore. So, the 10-year yield will again get ahead of that. That's what the bond market has done the last few years. It's just that the economic data has still stayed firm enough for them to kind of get back from their crowded trade. So kind of looked for that second half. That's kind of what I was telling CNBC. We're going to get more supply and wage growth should slow down. You put those two equilibriums together, there's your 1970s inflation. You can't have it happen, right? You can't have rents inflation go up. You can't have CPI really go up too strong unless rent inflation takes off. So you need major wage growth and supply suppression for that to re-accelerate higher. So kind of look at that second half of 2024, follow the labor data, follow that labor week has 4 different reports, go into that and look at that 3.5% to 3% wage growth target area. That to me would be a game changer from what we've had to deal with the labor market in the past. And we're heading in that direction.
Good news maybe for the second half of 2024 then. And it'll be interesting to see. We saw a couple years ago, for several years, like we had this pickup in home buying in the fall in a time when we didn't really expect it.
Yeah, what's interesting? Our biggest home sale reports come in winter. And it was like that in the previous decade as well. So the housing demand is very seasonal with purchase application. Like purchase application data is almost done in terms of its seasonal demand curve. But again, those buyers are in a sense in there. So when you're working from very low levels of sales, if rates fall and mortgage demand picks up, it nudges it up higher. And that's been the case. And we've seen that, lower rate move back-to-back years happen in the second half, starting from November, in 2022 and 2023. So we'll see what that works. But again, we follow the weekly data, give you guys all the information. And then we see a trend, you go with that trend until it reverses and the labor market is getting softer. That's key for the Fed. Again, I'm not a Fed pivot person until the labor market breaks. That's their confidence that they're talking about. We need confidence that the inflation. No. Right? When's this labor market going to get weaker? Right? And then it gives them cover, right? Think about the Fed wants cover, right? They want cover to pivot. And the labor market's breaking. We have to do our job, dual mandate. If you guys listen to what the Fed is saying the last 2 months, you could pick this up. It took them a little bit longer than I thought for them to admit it, but they're like jobless claims, job openings. There's put them all together. They're kind of telling you where they want to go.
Yeah, that's great. I mean, we don't ever want to wish a recession on the American people or anything like that.
No, absolutely. I have a lot of people say we need a recession for mortgage. No, we never, ever, ever root for a job loss recession. Anti-central bank crazy people do that. That's a fanatical group of depressed men. Russian trolls, Chinese trolls. I get why they do it, but domestic, we got problems with that, right? We never want to be that group, right?
No, we don't. But, we will see the silver lining of any sort of, small job losses coming into housing, which has already been in a recession, as we said. So yeah. I would wish it for us. Better news ahead. All right. Thanks, Logan. We'll talk to you again soon. Appreciate you.
See ya.